For decades, silver has occupied an uncomfortable position in the financial system, too industrial to be treated like gold, too monetary to be dismissed as a base metal, and that ambiguity is beginning to matter again, in ways most market participants weren't prepared for. Quietly at first, the price action started to change character, not in the dramatic spikes that grab headlines, but in the steady refusal to retreat the way silver historically has when enthusiasm fades. Traders noticed the resilience before analysts did, and dealers noticed something else entirely, because what was happening on screens didn't fully explain what was happening across their counters. At the retail level, conversations began shifting. Orders that used to come in batches became fragmented, cautious, almost probing, as buyers tested availability rather than price. That subtle behavioral change mattered because it suggested concern wasn't about timing the market anymore, it was about securing metal at all, and that raised questions dealers weren't eager to answer. Behind closed doors, wholesalers started adjusting terms. Delivery windows stretched slightly, then unpredictably. Quotes became shorter-lived. Policies that had been static for years were suddenly being reviewed, a phrase that in this industry usually means someone upstream is exerting pressure that can't be acknowledged publicly. What made this different from prior silver rallies was the absence of a single narrative. There was no dominant macro story to point to, no consensus catalyst that explained why demand felt persistent rather than speculative. When markets move without a clean explanation, institutions pay closer attention because unaccounted demand tends to surface later as a structural issue. In the United States, where silver's dual role is deeply embedded in both manufacturing supply chains and private investment culture, that ambiguity creates a specific kind of tension. Industrial buyers don't announce urgency until they're forced to, and retail investors tend to act long before policymakers acknowledge anything unusual. Dealers sit between those two groups, and they're often the first to sense imbalance. At first, policy changes were framed as routine risk management. Purchase limits were adjusted here and there, not eliminated, but refined. Buyback terms were rewritten in language that emphasized market conditions, a neutral phrase that masks discomfort. None of this was communicated loudly because drawing attention to constraint can accelerate it. What unsettled experienced observers was the consistency. Different dealers, different regions, similar adjustments, all within a compressed time frame. That kind of alignment rarely comes from coincidence. It usually means multiple parties are responding to the same pressure, even if they interpret it differently. The futures market offered little clarity. Price movements suggested optimism, but not panic. Volatility remained contained, which under normal circumstances would imply healthy liquidity. Yet the physical market was telling a more complicated story, one where liquidity existed, but only under increasingly specific conditions. Some institutional desks began revisiting assumptions they hadn't challenged in years. Silver inventories are notoriously opaque, spread across private vaults, industrial reserves, and exchange-linked holdings that don't always behave as advertised. When availability becomes a question rather than an assumption, models lose precision quickly. Dealers, meanwhile, had to decide how much transparency was too much. Say nothing and risk client frustration later. Say too much and risk accelerating demand into something unmanageable. Many chose a third option, incremental change without explanation, hoping conditions would normalize before anyone forced the issue. But normalization depends on something giving way. Either demand cools, supply responds, or prices move enough to ration interest. Early indications suggest none of those outcomes are unfolding cleanly, which leaves the system in an unstable middle ground that can't persist indefinitely. The most telling sign wasn't the surge itself, but how professionals began speaking off the record. The language shifted from opportunity to exposure, from upside to contingency. When that happens in a market as historically misunderstood as silver, it usually means the visible price is only part of the story, and the rest is developing where few are looking. Part 2 begins where the public narrative thins out, because the real strain doesn't show up in price charts. It shows up in logistics, and that's where silver markets tend to fracture first. Almost unnoticed, delivery timelines stopped being predictable. What used to be quoted in days became framed in estimates, then ranges, then conditional language that placed responsibility everywhere except on the dealer. That shift wasn't cosmetic. In physical metals, uncertainty around delivery is a proxy for uncertainty around sourcing, and sourcing is where pressure accumulates long before it becomes visible. Large buyers felt it differently than retail clients. Industrial users don't ask whether metal is available. They assume it is, and structure production around that assumption. When lead times quietly expand, they compensate by pulling orders forward, building buffer inventories without announcing it. That behavior doesn't spike demand overnight, but it changes its texture, making it steadier and harder to dislodge. Retail demand, by contrast, became more erratic but no less persistent. Smaller orders increased in frequency, suggesting buyers were spreading purchases over time rather than stepping away. That pattern matters because it's resistant to price corrections. When buyers aren't all in at one level, they don't all exit at the same time either. Dealers found themselves navigating between these two forces with limited flexibility. Inventory turnover slowed even as sales volumes held up, a combination that compresses margins and raises operational risk. To compensate, policies tightened, not dramatically, but enough to signal discomfort to those who knew what to look for. Minimum purchase requirements appeared where none had existed. Allocation language crept into order confirmations, framed as fairness, but driven by necessity. Even buyback policies, usually a pressure release valve, became more selective, with grading standards enforced more strictly and settlement terms adjusted quietly. None of this was coordinated in any formal sense, but the similarities were striking. Dealers rarely change long-standing policies without cause, and they almost never do so in isolation. When multiple firms reach the same conclusions independently, it usually means the underlying data is difficult to ignore. At the wholesale level, conversations grew more guarded. Suppliers avoided firm commitments beyond the near term. Some preferred to quote premiums instead of prices, decoupling the transaction from spot volatility and placing risk back on the buyer. That approach protects balance sheets, but it also reveals uncertainty about replacement cost. The futures market continued to provide plausible deniability. As long as contracts cleared and delivery obligations appeared manageable, official narratives held. But seasoned participants know futures are a confidence structure, not a warehouse, and confidence structures rely on assumptions that don't get tested until they're already strained. What complicated matters further was silver's industrial footprint. Unlike gold, it isn't hoarded for its own sake alone. It's consumed, transformed, and dispersed into products that don't come back to the market easily. When industrial demand overlaps with investment demand, even modest shifts can have outsized effects. Available data suggests some manufacturers began reassessing just-in-time sourcing models, particularly in sectors where silver content is small but irreplaceable. Those reassessments don't make headlines, but they influence procurement behavior in ways that ripple outward slowly, then all at once. For dealers watching these currents converge, the challenge wasn't predicting price. It was managing exposure. Carry too much inventory and risk replacement shock. Carry too little and risk losing client trust. Policy adjustments became the only lever left, and even that lever felt increasingly blunt. What made the situation uneasy was the absence of a release mechanism. No surge in mine output was imminent. Recycling flows didn't show signs of accelerating, and demand, while not explosive, refused to dissipate. That combination doesn't create panic, but it does create fragility, and fragility has a habit of revealing itself without warning. As these pressures built beneath the surface, the question shifted from whether silver prices were rising to whether the market structure supporting those prices was quietly being rewritten, and who would notice first when the old assumptions finally broke. Part 3 moves away from transactions and into incentives, because markets don't tighten simply due to demand. They tighten when participants begin protecting themselves against outcomes they can't fully model. In silver, that protective instinct showed up in how risk was being priced, not just in premiums, but in behavior. Dealers became less willing to warehouse exposure, preferring faster turnover even at the cost of volume. That's a subtle signal because in normal conditions, inventory is an asset. When it starts being treated like a liability, something upstream has changed. Refiners, rarely discussed outside industry circles, played a quiet role in this shift. Their capacity is finite, their timelines rigid, and their margins sensitive to input volatility. When feedstock flows become uneven, refiners prioritize consistency over scale. That decision cascades downstream, limiting how quickly raw material can be converted into deliverable form. For institutional buyers, this introduces a new variable, reliability. Price can be hedged, but delivery risk is harder to insure against. Some desks reportedly began valuing certainty more than marginal savings, favoring established relationships over open market sourcing. That kind of preference distorts liquidity in ways traditional metrics don't capture. Meanwhile, silver's role in financial products added another layer of complexity. Exchange-linked holdings are often assumed to be interchangeable with physical supply, but their behavior depends on redemption mechanics that aren't stress-tested during calm periods. When confidence is high, that distinction doesn't matter. When it isn't, it matters quickly. What's notable is how little of this reached public discourse. Analysts focused on macro drivers, rates, currencies, inflation expectations, because those are familiar frameworks. But frameworks can obscure as much as they explain, especially when the market's stress points are operational rather than theoretical. In the United States, regulatory structures add to that opacity. Reporting requirements capture price and volume, not friction. They don't measure hesitation, shortened quote windows, or the quiet refusal to commit beyond the next shipment. Yet those are the signals professionals watch when conditions begin to shift. Another underappreciated factor was substitution risk, or rather the lack of it. In many industrial applications, silver content is minimal relative to total cost, which reduces price sensitivity. When something can't easily be replaced and doesn't meaningfully affect the final price, demand becomes stubborn almost by default. That stubbornness feeds back into investor psychology, even if indirectly. As word spreads, often informally, that physical sourcing isn't as effortless as it once was, the motivation to hold metal changes. It's no longer just about appreciation, it's about access. Markets behave differently when access becomes a concern. Dealers felt that change in tone during routine interactions. Questions shifted from, "Is now a good time?" to, "How long does this take?" and "What happens if I wait?" Those aren't speculative questions, they're contingency questions, and they signal a different phase of engagement. None of this implies imminent breakdown. Systems can absorb a surprising amount of strain without visible disruption, but they do so by redistributing risk, often onto participants least equipped to manage it. When that redistribution accelerates, it tends to surface abruptly, not gradually. The tension, then, wasn't about whether silver could sustain higher prices, but whether the market's internal assumptions about availability, liquidity, and responsiveness were still valid under current conditions. Once those assumptions are questioned, even quietly, behavior changes first and prices follow later. As these behavioral shifts accumulated, they began intersecting in ways that no single participant could see in full, setting the stage for outcomes that wouldn't be triggered by news or data releases, but by the simple realization that the market wasn't functioning the way it used to. Part 4 is where the pattern starts to feel less like a cycle and more like a structural adjustment, because the responses weren't reversing when prices paused, they were becoming embedded. One of the clearest signs was policy permanence. Temporary measures have expiration language. These didn't. Purchase limits, revised settlement terms, and inventory disclaimers stayed in place even during periods of softer price action. That persistence suggests the issue wasn't volatility, but baseline confidence in sourcing. At the same time, communication styles shifted. Dealers became more procedural, less conversational. Orders were processed, not discussed. That change may seem trivial, but in relationship-driven markets, it often signals that discretion has narrowed and flexibility has been replaced by rules that can be defended internally. Behind that rigidity sits balance sheet pressure. Carrying physical metal ties up capital, exposes firms to price swings, and depends on replacement certainty to remain viable. When replacement certainty erodes, even slightly, the rational response is to limit exposure before the risk becomes obvious to everyone else. Banks that provide financing to the metals trade are acutely sensitive to that dynamic. Inventory-backed credit lines rely on assumptions about liquidity and mark-to-market stability. When those assumptions are questioned, lenders respond not with announcements, but with tighter terms, higher haircuts, and shorter review cycles. Those adjustments ripple outward quietly. A dealer facing stricter financing terms has fewer options, even if demand is strong. Raising prices doesn't solve the problem if inventory can't be replenished reliably. The only remaining lever is control over volume, timing, and counterparties. What made the situation particularly opaque was the lack of a single choke point. Silver supply isn't centralized. It flows from mines, recycling streams, and byproduct output tied to other metals. Each of those sources responds to different incentives, which makes coordinated response unlikely in the short term. Byproduct production is especially inflexible. When silver output depends on copper or zinc economics, it doesn't respond meaningfully to silver's price signals alone. That creates lag, and lag creates vulnerability when demand shifts faster than supply can adapt. Available data suggests recycling responded modestly, but not decisively. Recycling requires both price incentive and material availability, and much of silver's industrial use disperses it beyond economical recovery. That limits how quickly secondary supply can fill gaps. For institutional participants, this combination complicates planning. Models assume elasticity that may no longer exist at the margins. When elasticity disappears, small changes in demand can produce disproportionate effects, not immediately in price, but in access. Retail investors sensed this indirectly. Even those not following market structure began noticing differences in how transactions unfolded. The experience felt less liquid, less assured, even when quotes remained competitive. Perception matters because it influences behavior long before fundamentals are formally acknowledged. What's notable is how little corrective force emerged. Normally, higher prices attract sellers, but many holders appeared reluctant to part with physical metal, especially in smaller denominations. That reluctance removes supply without showing up as demand, tightening conditions invisibly. As these elements reinforced each other, the market entered a feedback loop that didn't require speculation to persist. It only required participants to act rationally within narrower constraints. That's how structural shifts take hold, not through panic, but through consistency. By this point, the question had evolved again. It was no longer about whether dealer policies would revert, but whether the market could return to its previous assumptions at all without a significant rebalancing event that no one seemed eager to trigger. Part 5 centers on the unintended consequences, because when markets adapt defensively, the effects often surface far from where the original pressure began. As dealer policies tightened, activity didn't disappear, it migrated. Private transactions increased, peer-to-peer channels grew quieter but more active, and off-exchange sourcing became more attractive despite higher friction. That migration reduces transparency, which in turn makes price discovery less reliable. Less reliable price discovery doesn't mean prices are wrong, it means they're incomplete. When a growing share of transactions occurs outside visible channels, the signals institutions rely on become lagging indicators. By the time adjustments appear in reported data, the underlying behavior has often moved on. Institutional investors, particularly those with mandates tied to liquidity thresholds, began paying closer attention to that gap. Liquidity isn't just volume, it's the ability to transact without moving the market or waiting indefinitely. When access becomes conditional, liquidity effectively shrinks even if nominal volumes remain steady. This has implications for hedging strategies. Paper instruments assume the ability to convert exposure into physical form under defined conditions. When those conditions blur, hedges become theoretical. That doesn't cause immediate failure, but it forces risk managers to reassess correlations they've taken for granted. In the United States, this reassessment is complicated by silver's role across multiple asset classes. It sits at the intersection of commodities, precious metals, and industrial inputs. Stress in one segment can spill into others in ways that aren't linear or easily isolated. Some market participants reportedly responded by reducing leverage rather than increasing exposure. That choice runs counter to the narrative of speculative excess, suggesting the dominant impulse wasn't greed but caution. When leverage contracts in a rising market, it often signals that participants are unsure what they're being compensated for. Dealers felt that caution in how clients structured orders. Staggered purchases replaced lump sums. Standing instructions replaced one-time trades. Those tactics smooth execution, but they also indicate an expectation that conditions won't normalize quickly. At the same time, the cost of certainty rose. Expedited delivery, guaranteed allocation, and specific sourcing commands premiums that weren't standard before. Those premiums don't reflect scarcity alone. They reflect the value of reliability in an environment where reliability can't be assumed. What's striking is how little resistance there was to these changes. Clients adjusted without protest, absorbing higher costs and tighter terms, as if they anticipated them. That acceptance suggests the market had internalized a new baseline faster than public commentary acknowledged. Manufacturers, too, began factoring higher buffer inventories into cost structures. Even modest increases in safety stock can have outsized effects when applied across entire industries. Those effects don't show up as spikes, but as a steady elevation of demand that's difficult to reverse. The feedback loop deepened. Higher buffer inventories reduced available spot supply, reinforcing the need for buffers. Dealer caution reinforced buyer caution, and both fed into a market that felt increasingly deliberate rather than reactive. Yet deliberation has its own risks. When participants move slowly and defensively, imbalances can build without obvious warning signs. By the time they surface, the adjustment required is larger than anyone intended. As these second-order effects accumulated, the silver market began exhibiting characteristics that didn't fit familiar cycles. It wasn't overheating, but it wasn't clearing either, and that ambiguous state tends to resolve itself in ways that surprise even experienced observers. Part 6 turns to the institutional lens, because what looks like friction at the retail and dealer level becomes something else entirely when viewed through risk committees and procurement offices. For large institutions, silver isn't evaluated in isolation. It's one line item among many, competing for capital, attention, and tolerance. When its risk profile changes, not dramatically, but persistently, it triggers reviews that can alter behavior without ever touching public markets. Those reviews often start with simple questions. How dependable is supply under stress? How correlated is price with availability? How quickly can exposure be adjusted if assumptions fail? When the answers become less certain, position sizing changes even if conviction doesn't. Some institutions reportedly began favoring physical allocation over synthetic exposure, not as a bet on price, but as a hedge against operational uncertainty. That shift is subtle because it doesn't require aggressive buying. It only requires not selling when prices rise and reallocating incrementally over time. Others took the opposite approach, reducing visible exposure while maintaining optionality through less obvious channels. Both strategies share a common theme: minimizing reliance on a market structure that feels less predictable than before. What complicates this for policymakers and regulators is the absence of a clear trigger. There's no single event to point to, no failure that demands intervention. Everything remains functional, just less flexible. Systems are particularly difficult to manage in that state because traditional warning indicators stay quiet. Silver's industrial integration adds another layer of institutional concern. In sectors where it's a critical input, procurement teams began coordinating more closely with finance, blurring roles that are usually separate. When sourcing becomes strategic rather than routine, it signals a shift in perceived risk. That coordination often leads to conservative decisions. Longer contracts, diversified suppliers, higher inventories. Each choice makes sense individually. Collectively, they reinforce demand in a way that isn't sensitive to short-term price movement. At the same time, investment committees became more attuned to tail risks. Silver's historical volatility makes it easy to dismiss stability as temporary. But when stability coincides with tightening access, it challenges that reflex. Stability stops looking benign and starts looking conditional. Dealers, positioned between these institutional shifts and retail behavior, found themselves with less room to maneuver. The more predictable client behavior became, the more rigid internal policies had to be. Flexibility migrated upward, away from the point of sale. One underappreciated consequence was how these dynamics affected smaller participants. Independent dealers and refiners with limited balance sheets faced the greatest pressure. Some scaled back operations quietly, reducing market depth without making headlines. That reduction in depth doesn't announce itself. It shows up as thinner order books, fewer competitive quotes, and longer response times. Each change is minor on its own. Together, they alter the market's character. As institutional behavior adjusted, it also began influencing expectations. Analysts who rely on historical relationships found their forecasts drifting off target, not because the data was wrong, but because the underlying relationships were changing. By this stage, the silver market was operating under a new set of informal rules, none of them codified, all of them enforced by behavior rather than regulation. Those rules can persist for long periods until something forces them into the open. And when that happens, the adjustment tends to be rapid because the groundwork has already been laid quietly, out of view of anyone still watching only the price. Part 7 focuses on the fault lines because once informal rules take hold, the stress points aren't evenly distributed. They concentrate where assumptions remain outdated. One such fault line sits between paper representation and physical reality. As long as conversion is assumed to be seamless, discrepancies stay theoretical. But when participants begin questioning that assumption, even quietly, the relationship between the two becomes fragile rather than flexible. This fragility doesn't require a breakdown to matter. It only requires enough participants to behave as if conversion might be inconvenient, delayed, or conditional. That behavior alone can change flows, redirecting metal away from channels that depend on constant turnover. Another fault line runs through inventory reporting. Public figures tend to aggregate holdings without distinguishing intent. Metal held for immediate use, long-term storage, or contractual obligation often appears identical on paper. When intentions diverge, those aggregates lose explanatory power. Dealers learn to read between those lines. A reported inventory level means little if the metal isn't mobilizable under current terms. As that realization spreads, confidence becomes less about totals and more about accessibility, a much harder variable to quantify. Geography adds further complexity. Domestic sourcing preferences, transportation constraints, and jurisdictional risk all influence how quickly metal can move. In the U.S., where logistics networks are extensive but not frictionless, small delays compound when volumes increase even modestly. Insurance and compliance considerations also began playing a larger role. Higher values raise premiums, stricter policies slow movement, and additional checks lengthen settlement cycles. None of these stop transactions, but they add drag, and drag matters in markets accustomed to speed. What's notable is how these constraints interact. Each one is manageable alone. Together, they reduce optionality. When optionality declines, participants hedge by committing earlier, holding longer, and releasing less. That behavior tightens conditions without any single actor intending to. Retail investors often sense this last, but react decisively when they do. Reports of limited availability, even when localized or temporary, carry disproportionate weight in a market shaped by memory of past dislocations. Perception becomes a force multiplier. Dealers respond to perception with caution because correcting it publicly risks amplifying it. Silence becomes policy, but silence creates its own interpretations. In that environment, behavior speaks louder than statements. Institutional players watch these reactions carefully. They're less concerned with retail volumes than with what retail behavior signals about confidence. When smaller participants act defensively, it suggests uncertainty has diffused beyond professional circles. By now, the silver market was exhibiting a familiar but rarely acknowledged pattern: stability on the surface, tension underneath. Prices moved within plausible ranges, transactions cleared. Yet the effort required to maintain that appearance was increasing. Markets can sustain that state for long periods, but they don't exit it gently. Resolution tends to come from an external shock or an internal recognition that existing practices no longer serve their purpose. The challenge is that neither requires dramatic catalysts. Sometimes the shift begins with a policy memo, a financing adjustment, or a procurement decision that seems inconsequential in isolation. But when it aligns with pressures already in place, it can accelerate change rapidly. As these fault lines widened subtly, the silver market edged closer to a moment where its quiet adaptations would need to reconcile with public expectations. And that reconciliation rarely happens without consequences someone didn't plan for.